Hi, everyone. This is Bruce at Fleet Capital Management. It is Friday afternoon, the 23rd of September, 2022. We're into fall, which is usually a pretty good time for the market. At least late October is usually when the rally starts towards year end. We'll have to see what happens this year. If you are not absolutely exhausted from watching this market for the last 9 months or so, I can tell you that I am. This has been a very, very difficult year, but we've been through difficult times before. This too shall pass. I'm going to show you some of that on some information that I'm going to present to you today. This one might be just a little bit longer. I'm going to go as quickly as possible, but there are some things I want to cover. Some that I've shown you before, many that I've shown you before, but I want to refresh your memory on that. As always, we need to cover this. The video presentation is intended for educational purposes only. Discussion of any security is not a recommendation to purchase or sell the security. Please subscribe to the channel, the YouTube channel. And as always, send me any questions to bruce@fleetcapitalmanagement.com. And like I've said before, if there are any topics or that you'd like me to cover or questions that you'd like me to cover in a future video, just let me know. I mean, I do these for you. So just let me know if there's something that you'd like to see specifically. Quick reminder, our homepage, fleetcapitalmanagement.com. You can always just click this lower button to get easy access to our market videos. And you can also click this upper button to get on my calendar, and we'll do a one-on-one and take a look. This is Zoom calls, and we'll take a look at your particular account so I can answer your questions specifically. This is a chart that I showed you quite a bit of time ago, a number of months, I should say. It feels like forever, but a number of months ago. But I thought I might go over this with you one more time. This is 42 years or 41 years of the S&P 500. And anything in orange is what the worst the market did during that year. So this is inside the year. This is intra-year. And then the blue on top is how the market closed. So for instance, during the year in 2003, market was down 14%, but it closed up 26%. Here in 09, it was down 28%, and it closed up 23%. Doesn't happen that way all the time. This was 08, this was the Great Recession. It was down 49%. But it closed down 38%, which is still pretty miserable. But the point is, when we get to the lows intra-year, with great regularity, we close much higher off of those lows. And to be honest, I'll be shocked if that's not the same thing this year. So anyway, I just want to show you that. Another thing that I show you from time to time is called the Fear and Greed Index Gauge. This is a reverse type of gauge. I can't think of the word I was looking for, but when we're in extreme fear, when the public is in extreme fear, that generally suggests that we're really close to a bottom in the market. When we're in extreme greed and everything's going great and we're making tons of money, when we get up to this level, it usually means we're getting close to a top in the market. So anytime we're in this area, I just want you to know the markets will generally bounce. And I will tell you, 1 year ago today, we were also at this 24 level of extreme fear. I'm going to show you what the market did in just a minute on that day, if I'll remember. Hopefully I will. Actually, I think I might do it right now. So it would have been September 23rd of 2021. Let's just go over there real quick and let's look at, I'm going to close this down a little bit and scroll this back. And let's see, there's 2021. Okay, I actually put a line on it for you. So a year ago, we were in extreme fear, and for a few more days, the market went down, but then we had a really nice rally into the end of the year. So once again, are any of these things perfect? No. Are they pretty close? Yeah, they really are. They work more times than they don't. So maybe we're near a market bottom. I was also looking at another chart. I'm just happened to choose a 3-year. This is a chart that Morningstar does every day, and they're looking to say, is the market overvalued or is it undervalued? And of course, we'd love to buy when it's undervalued. And that same time frame that we were looking at, which was early in 2020, was grossly undervalued. This was COVID, by the way. This was the COVID pullback. And when it changes, man, I keep saying it changes with a vengeance. It changed fast. And sometimes it gets overwon or overvalued and it comes back down. And here's where we are today. So we're not even as undervalued as we were then, but we're pretty close. And this was the June low. We're really, really close to that June low. So that's just another indication that we might be getting really close to a bottom. I hope we are. Here's the same type of thing, but it's just year to date. And here's that June low again. Almost all year, this market has been considered undervalued. Value investors will always buy down here because that's what the type of investor they are. Growth investors will buy once it starts to come back up, but we don't want to be in the overvalue too much. So it just depends on the type of investor you are. But once again, based on Morningstar research, we are significantly undervalued right now on the market. Okay, let's turn our attention to defined outcome ETFs for just a minute. This was an ETF that matured on August 31st of this year. And this one was compared to the S&P 500. And the light line down here is the S&P 500. And the top line, the dark line, is the investment. And as it is designed to do, in that last, I would say that last month, if you will, prior to expiration, it kind of just gets pulled back up to this zero line, no matter what the stock market is doing. Look how dramatic the fall was for the S&P 500. And this thing goes right back to zero. Even if we go back into July of 2022, I mean, the stock market was really getting hit hard, the S&P 500 return. And this thing was already starting to, like a magnet, move back up to its zero line. On the last day, which is the most important day, the fund was down 0.77% because they have some embedded fees. They've got to pay for the options that they're buying. So that's where that comes from. And the S&P 500 was down 12.49%. And that's for this duration from September 1st of 2021 to 8/31 of 2022. These investments are always 1 year or less. So as long as we're in the gray area towards the maturity, we should snap back to zero. So that's how they work. Let's take a look at my three largest holdings in these particular types of investments. I own a lot of them, but these are the three biggest concentrations. This one is PMAR, and what you're looking for is the last three letters. Obviously, that's March, and you can just know that this will mature the day before March starts. So what is that, February 28th or 29th, depending on the year, is when this will mature. And this is through today. This is capturing today. You can see how significantly the S&P is down. And yes, the investment is down, but we're nicely inside that gray area. So at this point, we really don't have anything to worry about. As of today, the investment is down almost 7%. And the S&P return for this period is down almost 16%. So a pretty significant difference, which is great. But you still see that 7% decline, and nobody likes to see that decline on their statements. I understand. So as we get closer to when will this mature? This will mature the end of February. We should be heading right back up to that zero line. This one is in April, so this one will mature March 31st coming up. And you can see this one's based on the NASDAQ or the Qs. The NASDAQ, this one has a 15% buffer. The NASDAQ is down significantly more than that, but we are still inside that gray zone, meaning we are protected to down 15%. Look at what happened last time the NASDAQ was way off and way below the buffer zone. This thing kind of just stopped at the buffer zone. It won't always do that, but the market knows where the gray area is, and these characteristics are seen, they're publicized. This is updated every 15 minutes. So it's pretty rare they go below, but as I'm going to show you in the next chart, they can. But again, when does this mature? This matures in April, so March 31st. Even if the market is down, and I don't think it will be, but even if it is, we should be heading right back up to the zero line. You get that money back. You get it back. Here is B APR. So this one, the B series just has a 9% downside buffer. Different ones have different characteristics. And you can see that the S&P is down pretty significantly, and the investment is below its buffer range. As a matter of fact, right now, the investment is down 12.6%. The SPY or S&P 500 is down 18.56%. Let's just say, so we have real clarity on this, that today was the day of maturity. Now, it's not, because will start to snap back, but let's just say it was, and we were down 12.61%. Is that really our loss? No, because 9% of it would be subtracted from that, so we would be down 3.61%, approximately, within some basis points for fees. So I hope that makes sense. So it can go down below the buffer zone. It will normally towards maturity come right back up, but let's just say it didn't. We would still be down around 3% when the market's down 18%. Not bad at all. Now, let me tell you about a change that's coming to my use of these investments. And remember, group one is a little more aggressive. Group two is a little bit more conservative. You know which accounts and that you fall into. So on maturity date, like this one matures March 31st of next year. If my indicators are showing we are in a bear market at that time, we will liquidate this security the day after the maturity. We have to wait to maturity to get our money back. The next morning, we'll liquidate it, and we will not go into a new one until we're in a bullish environment or a bullish situation. Now, that's going to be true for both groups, group one and group two. If we're in a real bullish situation, when we liquidate, group one may not even go back into this type of security because we're trying to get maximum rate of return. Group two will. So let's say today was a date of maturity. What I would do, and I don't need to look at the chart, but I just want to show it to you. I would go to my trend analysis page. And if we are in a downtrend, we would let it mature. We would not let it roll over. So we would then be in cash. If we then go back, or when we go back into an uptrend, we'll go back, especially for group two, into this type of security. So just now, why this change? Let me tell you exactly why. Even though you're protected for the most part, I know how difficult it is to see the value of your account go down. Even though I tell you over and over and over again, and I tell myself and I tell my wife, I mean, we're all the same, even though this is completely protected right now at maturity, we're seeing our account values fall. And I know how uncomfortable that is. So that's why the change. So even group two, which has sorry about that, which has a very large percentage of their portfolios in these types of investments, if on maturity we get our money back, yay, everybody's happy about that, we're going to just go into cash and we're not going to go into a new security until we're in a bull market. Hopefully that makes sense. I think that's going to be better for everyone. You know, it's not normal that we're in such a horrendous market as we are. As a matter of fact, a number of statisticians on the market are saying that this is the worst year the market has had in the last half a century. And it's not just because of the degree that we've gone down. They measure it by the degree we've gone down and the term, the length of time that we've been suffering in this. So this has been a horrendous year. And we're going to get most of this, money back. I mean, group two, I think 100% of the investments in your account right now are in defined outcome ETFs. So all those losses, you're going to get back on maturity. And we're not talking about waiting forever. This one, we're waiting till the end of March. The other one, we're made till the end of February. Some of them are coming due in November and December and January this year. So just depends on what we're in. Okay. Hopefully that makes sense. If you have questions about that, let me know. Let's go over here and let's go back to this chart. And what we're looking for is, how do we know when we're really close to a bottom? Well, that's what I'm going to show you now. And I'm going to show you a number of different things that suggest we are. There are no guarantees in the market, unfortunately. I wish there were. This is a company called VectorVest. I use them to scan and screen for stocks, but they're also really good at market timing. And I'm just going to show you two different market timing tools. They've got numerous ones, but one is called BSR. Just stands for the buy to sell ratio. And if you look over here, they are tracking 9,156 different stocks. So it's the entirety of the market. And they have a buy recommendation or a sell or a hold on every stock in their universe, 9,000 stocks. And what they're doing is they're looking for a ratio of buys to sells. Now, this is a scale from 0 to 2. So, and it goes in decimal. Right now, we're at 0.05. When we are above 1.00, that's a very bullish indication. So 1.00 up to 2.00 is very, very bullish. When we're on the downside, what VectorVest studies have shown is that when the BSR is at 0.20, which is 15 basis points above where we are now, when we're at 0.2, that means in their studies, this market is searching for a very powerful bottom. You know, we're really close. Based on this one indicator, it can only go down 5 more ticks and then it's out. It can't go down any more than that. This is about the lowest I've ever seen it. This is suggesting, based on history, that the market is very, very, very close to a low. MTI is it's a multi-indicator. It's looking at prices and it's looking at a number of different things, but it's calculated on a scale of 0 to 2, which is most of their indicators are. 1.0 and above is a bullish market, a bullish indication for them. And when it is down to 0.60, right now it's at 0.43. When it's at 0.60 or below, based on their studies, we are very, very close to a major bottom. So just looking at these two indicators can give us some hope that we might be close to the bottom. But again, nothing is 100%. Let's go look somewhere else. Here is my go, no-go charts, which are some of my favorites. I use them a lot. Here's the June low. I put this support resistance line right under the June low. And if you remember, we had Fibonacci retracement here. And actually, let me draw it for you so you can see it. Let's see here. Where's my Fibonacci? There's Fibonacci. And I'm going to go from down here. Oops. Let's see here. Yeah, we'll try that. We can go from down here. Oops. I'm sorry. For some reason, it pulled up the other thing that I needed. Fibonacci retracement. Here we go. So now let's try to capture it. And I need to change this to here. And what we're going to do is we're going to go from the swing low to the swing high right there. Okay. So there's our Fibonacci retracement. And what I've told you in past webinars is that a really strong, so here was the June low, we had this nice little rally. I just marked the very top. In a really strong bull market, it'll come down to around 38.2, bounce and continue. In a little bit weaker, but still a good bull market, it'll come down to this 50% level, bounce and continue on. And we're still in this short-term bull trend. In a weaker bull market, will come down to 61.8. Look how many times it came down to 61.8. I mean, it was pretty amazing. And I really was hoping that it would bounce. And if it bounces, then this short-term bull trend is called still intact. Unfortunately, what happened was it broke 61.8. And when it breaks 61.8, I can then remove it because it's no longer part of that analysis. We have broken that uptrend. Now let me move this back up just a little bit. Okay, so what I was going to show you is this was the June low, and that's why I have the support resistance line. We've broken through the Fibonacci retracement, and we are testing the prior low. That is something that is very, very common. We don't like it, but it's very common in technical analysis. Some people call it a test of the previous low. Some people call it a W bottom. See here, 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 and then hopefully back up. But either way, this should act as an area of support. Now, you can see that, remember, the tick to the left is the open of the market. The tick to the right is the close, or where we are now. The market's closed, so it's the close. The market went down almost, I mean, within a whiskers hair of the June low. And we're looking at the S&P 500. And then it closed more than halfway up. That's an interesting bar. That's an interesting bar. What that means is that the institutional buyers saw this. They came in with enormous amounts of money to push that back up. Maybe that's the test we were looking for. I don't know, but maybe that's the test we're looking for. And maybe we bounce off of that and start a new bull run. Another thing is, this down here is a momentum indicator. And when it's in this black area down here and it has a -6, that means that the market is oversold and looking for a bounce. So when we couple this with this and the market action that we saw today, maybe the market's ready for a bounce next week. I don't know, but this is typical. Now, what if next week we break below this? Well, then the pain is going to get worse. If it shouldn't break this. If it does, then we're going to go down lower, unfortunately. That's the way it works. But so far today, it went down really close to that spot. And the buyers came in, the bulls came in and pushed prices back up. Very bullish indication. We'll see what happens. So I hope that helps with some of that. Let's go back over to this chart for a second. This is, and I'm going to make this larger for you so you can read it, but bear with me a second here. Where was COVID? COVID was 2020. Let's see, it was early 2020. Did I miss it? No, there it is. Okay, so here was COVID. We had this incredible upward trajectory market for a long period of time. And I know I've got it small, but I'm trying to squeeze a lot in. Here's when COVID started and we went right down, and a number of things were interesting. The market was grossly oversold at that time, just like it kind of looks like it is now. And this was painful, but look how fast it came back up. It didn't take much time at all. And I mean, we were right back to where we were. So that's why I say sometimes when we're in an oversold, we get pretty dramatic bounces. Let me see if I can find another one for you. This almost looks like Christmas lights, doesn't it? No, this is this year, and we're coming back down. Here was the original Fibonacci retracement. Here, I'm going to make this larger for you now. Here was that same Fibonacci retracement. I just have it on a different chart. I haven't extended it out. You can see here's today. It came down to within a whiskers hair of that June low and then bounced back up. So lots of things need to happen to get this market in a bullish phase. This is also, stochastic is saying we're way oversold. This is the RSI is saying we are oversold. This is the TSI, the True Strength Index, saying we're oversold. We should be bouncing back up. Last time we were down at that level, market was down here and it had a nice little rally. So we need this 20-day to get back up above the 50-day. That's step one. We need the price to close above these ATR dots and get back into the bullish colored dots, the green colored dots. That's step two. When that starts to happen, everything's going to look better and we'll start getting back into the market. Ultimately, we need the 50-day above the 200-day. But we're not going to wait for that. Because if you wait for that, you miss a lot of the initial upside surge. What we want is above ATR dots, 20 above the 50, we're back in. We're back in because we're trying to, and just like we were here, just like we did here off of the June lows. We got back in because here our dots changed, our ATR, which again is average true range. We got above that. We went in. Unfortunately, we hit the 200-day moving average and we bounced back down again. So it doesn't mean we were wrong. It means it just didn't last that time. Sometimes it lasts for 6 months, 9 months, a year. But that's what we're looking for. We don't want to miss the V-type bottom if that's what we're going to get, where the prices start to explode to the upside. We don't want to miss that. So that's pretty much, I think, what I wanted to show you. Let's see if there was anything else. Oh, on options trading, especially for group one or anyone can be in my options program. We haven't been taking a lot of trades lately because I haven't gotten any signals lately. One of the last signals I got was on August 2nd. We went into an option. It worked out pretty well for us. We were up 27.4% in 10 days, which is a nice little trade. I do two different types of option trades. I do 21 to 25 day, meaning they mature in 21 to 25 days. And I do 7-day. And what I need for that to happen, this is a 60-minute chart. This is a 1-day chart. So on the 60-minute chart, this is what I use for my 7-day options, my really short-term options. This right here, and let me change this to this. Okay. You can see where that red line here crossed above the green line. These are called DMI lines, or directional market indicators. I actually should have bought a bearish 7-day option off of this, but I didn't for some other reasons. But these are generally really good signals. That would have obviously worked out. And this is 60 minutes per bar. This is not a day per bar. That trade would have worked out really well. I probably wouldn't have gotten into it until we got an official no-go. So it would have been right there. And it still would have worked out well. We've got a no-go signal. We have the red DMI on top, and we have our momentum falling. There's a little phrase that we use that you might want to remember, is that price follows momentum. Price follows momentum. So if we got a down signal, but the momentum was above that gold and it was in the positive territory, we would not take the signal. It's a bad signal because momentum is saying there's price momentum going up, even though the bars are saying price is going down. So in any event, that was a signal. I'm going to start taking these a lot more aggressively. For those of you who are trading options with me, when we get that red dot, is called a continuation trend. When we get one of those, that's another place that I could do a 7-day option. And when I say bearish option, meaning if the price is going down, that's fine. We profit as the market's going down. A bullish option, we profit as the market's going up. So these are agnostic to which way the market's going. And like I said, I'm going to get more and more aggressive, just meaning I'm going to follow these signals more tightly, because with experience in trading these, my confidence level is getting much, much higher. For the 21 to 25 day options, we did it right back here because we had a positive DMI, we had positive oscillator or momentum, lots of things, and that one worked. We made, like I said, 21+%. So you're going to see more and more of these options trades, I promise, on the downside or the upside. What's difficult, and I was explaining this to a client, we were out for a beer the other night. I was explaining that when we're down in this area that looks like support, where the market might bounce, let's say I get a signal to do a bearish option right here. Well, because we're right at a point where technically this thing could bounce, I ignore those signals because I'm trying to stack odds in our favor, not take them away from us. So I hope that makes sense. I'm going to show you one more thing with options that I've been testing in my account, but it's not ready for your account. These are really short-term options. These are 7 to 10 day options. Where it's green line, that means I profited from it. This one had a 43% profit. This one had a 31% loss. This one had a 6% profit. AMD, this one's in about it's open right now. And when I have green in my stop box, I'll tell you what that means. That means that I cannot lose on this position, because where my stop is, I bought this option at $7.90. Which equates to $790. But I bought it at $7.90, and my stop is at $10.25. So even if I get stopped out, I'm profitable. So this turns green when there's no way I can lose on the trade. Philip Morris, I am in. That was a 7-day put, and these are puts as the market's been coming down. I bought that at $3.60. My stop is now $5.40. The price is currently much higher than these, but when it comes down, if I were to get stopped out, I'm profitable. So these are starting to work out really well. I may start extending these into client accounts soon. I'm not there yet. I would rather stick with the S&P options. They're much more liquid. So okay, so I'm out of breath. You're probably getting tired of hearing me talk about this. The market is been hard as hell this year. I mean, it's just two ways around it. I've explained the defined outcome ETFs. You've got lots of protection, but I know you don't like seeing the accounts go down. I'm going to fix that. Like I said, going forward, let's hope that this low holds, and it's just a test of the prior low, and we'll learn a lot about that next week, I suspect. And like I said, even going backwards, a lot of these things are saying that the market's in lows. So we're just going to have to wait and see what happens next week. But again, we've been through, oh, I apologize. There's one more thing I want to show you that I think you're going to find interesting. I've got to figure out which chart I put it on. Let's go to this chart. You're going to like this. This is a daily. I'm going to go to a monthly chart on the S&P 500. Let me move this. And here is that support resistance. This was that June low, and this is where it just looks different because now we're on monthly bars. Where did let me see what that did. Hang on one sec. Let's go to percent change. Let's make that white. This was COVID. And if I start at the very top, the high, and then I come down to the very bottom of what was the low, hopefully that's accurate. If it's not, it's very, very close. That drawdown was 35.55%. Okay. If I do the same thing here, and I start at our high, which was right around January 1st, and I go to our low, which is just a hair above that line, right about there, we are down 22.96. So even though this feels pretty horrible, we're nowhere, the amount of drawdown is nowhere near what it was in COVID. It's just this was very fast. This was like 2 months. This has been 9 months. That's why. Even though it's a lesser drawdown from swing high to swing low, it's been 9 months that we've been dealing with this. This was 2, and then it started to run back up because these are monthly bars. But when you come back out and you look at monthly bars, you can see that when we're in a real bull trend, which we were, these are monthly bars. This takes a long time. This is going back to 2012. You know, the market generally goes up, and this was a period that it went down a little bit. That was in 2015. Most of you were with me in 2015. We escaped a lot of that pain. We were in cash for a long time in 2015, but still, you know, then we got back in and rode it up, and then there was a little dip in 2019, but then this was the big one. This was COVID, and then this is now. And again, like I said, when the researcher said that this has been the toughest year in the last half century, it's a combination of degree of decline and length of decline, because length of decline is very wearing on people. So let's hope that holds, that bottom holds right where that line is drawn, and that we're getting really close to being done. I hope we are, but you know, we have to watch the charts. The charts will tell us when it's time to get back in, and we will jump back in. Okay, so that's the story. I hope this helped. I know I went through a lot of information quickly. You can always watch it again if you miss some things, or you can just click that tab on my website, and we will be happy to set up a meeting and go over it with you. So that's the story. Have a great weekend. Try to forget about the market during the weekend, and we'll be back at this Monday morning. I'll be with you then. Bye-bye.